So this video is in response to a question a student asked, a perfectly legitimate, understandable question about debits and credits. Not understanding why expenses are debit-type transactions and revenues are credit-type transactions. And so I just thought I'd take a few minutes to hopefully explain it. The first thing is expenses are not equal to what you owe, okay? You can have an expense, say it's a supplies expense, and that can be, you can pay for it right away, in which case you'd have a journal entry that said we had supplies expense increased by a debit and our cash went down and cash is decreased by a credit. The other thing that could happen, you could buy the same supplies except not pay for them right away, and so you'd have accounts payable and supplies expense. And in this case, your supplies expense, you have more supplies expense, and you have more money that you owe. And that's just the way these work. So if you want to think of, I'll try to give a little bit of explanation in terms of the accounting equation. Probably the first thing you should look at, if you haven't already, is in the introduction to Chapter 2. There's a what you need to know piece. And then there's another one that's the actual introduction. It says introduction. And that really gets you set up for all the debit and credit stuff, okay? But let me just see what I can do. So we get assets equal our liabilities plus our stockholders' equity. And you have to get away from debits being good or bad or anything like that. The simple fact is that debits are going to increase some accounts and decrease other accounts. You have to get used to that idea too. It does end up making sense after a while, but it takes a while. When I first started taking accounting, it took me about a month to figure this equation out. Once I did, I'm like, oh. So I like to think of it as really just kind of a mechanical, clunky machine, this accounting equation. So over here, you've got, and I'm going to use the T accounts here, you've got your assets. So let me just do specific ones, okay? So say you've got your cash, and you'd have your other assets. Those are increased by a debit and decreased by a credit, okay? So then, your assets always have to equal your liabilities plus your stockholders' equity. Your liabilities, so we'll just pick one account, we'll go accounts payable. They're going to be increased by a credit entry and decreased by debits. And then say your accounts here, you've got your common stock, and that's going to be increased like that and decreased. So these are increased by debits. And then this is the where it gets a little tricky. Retained earnings is the overall account, and that also is increased by a credit. Okay, now, you have to think back to Chapter 1 where we did the financial statements, and you think about sort of how all of this works together. And that's really what this question was all about. Why do we have revenues increased by a credit and expenses increased by a debit? It doesn't make sense. Shouldn't it be the other way around? Because, I don't know, why shouldn't it be the other way around? The answer is it isn't the other way around. Okay, so if we think about retained earnings, when we do the retained earnings statement, if you remember, we start with beginning retained earnings, we add our net income, and net income is your revenues minus your expenses. So all the things that go into retained earnings, you've got your revenues minus your expenses minus your dividends, all get into retained earnings. And so now I'm going to try to get to the answer to this question of why. Okay, so retained earnings are increased by a credit. So if we have these are the little accounts that get closed into it. So revenues are increased by a credit because they're increasing this whole stockholders' equity section. They're increasing the retained earnings, which is increased by a credit. Expenses are going to decrease your retained earnings, and so your whole stockholders' equity. And so a decrease, your more expense means less retained earnings, okay? So In other words, you've got more expenses, but if you look at these as part of this overall, they get closed into this account. And the same thing with your dividends. So you have to think of it as a very sort of mechanical process. The more dividends you pay out, the more it decreases your retained earnings, okay? So that is the best explanation I can give of that, and I hope it helps.